Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 23rd, and we'll see how things look for Thursday, July 24th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, set a new all-time high with the NASDAQ and the S&P 500. Not seeing an awful lot of under-the-surface strength. We're seeing some improvement, but we're still seeing a general move where value, growth had a good day. Value is starting to see some favor as well. We just want to keep an eye on that. Now we're in the part of July, which tends to underperform the first half of July, but you wouldn't know that by Wednesday's session. Here we are setting all-time highs, but there's not an awful lot of conviction. The market is still looking pretty exhausted at this point. We have sentiment way back at extreme now, coming in at 76. So it's like, okay, is the market getting set up to have a good July, which so far looks that way? Are things going to shift a little bit when we get into August and then eventually into September? We don't know that. It's just looking ahead. I don't forecast, but we just want to keep an eye on the evidence of what's actually happening. But setting all-time highs, that's positive in and of itself. So right at the open, we had a higher open. Now this came after some trade deals were announced with Japan and Indonesia and the Philippines. That really helped the Asian markets. They were up pretty strong. That carried over into Europe, and then Europe carried over into the US session as well. So we did have a higher open, and we actually set the base at the open. We didn't see much of a move after that at R1 at 63.23, and then we climbed above R2 at 63.37. We never did get up to R3. I had that calculated, but we didn't reach that level. We were able to hold on to the gains. We didn't see an awful lot of selling into strength. And then we went above R2 and actually got above 63.50. And we closed right at the intraday high. So you look at the chart, it's pretty positive looking. We just want to look under the surface and see if we can get any clues as to what's happening. We were up 0.78% on above average volume. We've seen 2 days now where value had a good day on Tuesday. And it's not like growth is falling apart by any means. It's still positive. But we're seeing a little bit of a shift that's still continuing. And we just want to watch that and see if it continues to unfold that way. And we are positive on all time frames. And you can't get much more positive than setting all-time highs. So the short term, intermediate term, long term, positive. Look, even looking a little extreme in the long term right now. Interest rates are going back up though, but that doesn't seem to have that big of an impact currently on what's happening in the stock market. A lot of the optimism right now has to do with the trade deals that are going on. So some comments. Both the S&P and NASDAQ did set new all-time highs. The NASDAQ 100 didn't do it, at least in Wednesday's session, and we're hitting a little overhead resistance there. And if you watch the intermarket analysis video over the weekend, we've been seeing a general shift where the NASDAQ is actually outperforming the NASDAQ 100, which is not what you usually see in a really solid market. I mean, they're both doing well, but we're seeing more broad participation, which you can take that in a positive way. And then the gains were led by earnings report optimism. And this is what I've been saying because I've also been trying to warn about, okay, the last couple of years, we hit the middle part of July and then things go into a decline. Well, so far that has not materialized. And I hope it doesn't. As I say over and over, the market's a better place when it's going up because people's retirements are doing better and their net worth is increasing, and you might have areas in your life that are more frustrating. Well, at least you can look at the stock market and go, all right, my portfolio or my retirement's doing well. And so there is some optimism still behind this earnings season that we're coming into, even though, yeah, there's some manipulation that goes on there. They lowball the companies do. They think, well, this is what we think the report's going to be like. And then when the report comes out, it beats the estimates and everybody's happy. And there tends to be a pop after that. At least that's the hope. A lot of times we'll see buying on the rumor and then selling on the news when a company sells off after they report earnings. And then trade deal announcements. And there's talk of one right now that the EU, we might be reaching a trade agreement, and then the one with Japan. And from what I've seen, it looks like the EU and the Japanese plan are fairly similar to each other because they're both just massively big trading partners. So with Japan, there's a 15% tariff, which is better than the 30% on Japanese imports, and they're going to invest 550 billion in the US. Okay, that's a good thing there. And an opening of Japan's markets to rice and auto imports from the US. All right, so I guess we're going to send rice to Japan. Something doesn't seem right about that. But then with the EU, they're close to an agreement, and it's not quite there yet. Also with the 15% tariff versus the 30% tariff that kind of was freaking everybody out there. But it's not done yet. They're just close. And semis didn't have a really good day, though. And this is a main part of growth because semis are part of the tech sector. When they're both doing well and semis are doing even better, that's when the market's a little more powerful. Small caps and mid caps had another good day. Still a ways to go. Still not in an uptrend yet. We're not seeing a golden cross. We're close. It could happen pretty soon, but we're not there yet. Now, the short-term extreme positive readings, we're seeing more of our usual charts on here now. The Stochk RSI, it wasn't on the list before. Now it's on that list. So that's showing good, solid, positive short-term momentum. The Williams percent R, which has been on the list, both the CCI 14 and 20. The 20 had fallen off. Now it's back on. Stochastics, which always seem to be on the list. And then we are still negative with the slope oscillator. Our momentum oscillators aren't really kicking into gear. They're actually still drifting lower. And now we're back to being far away from the 20-period moving average as measured by the boom indicator and then the short-term RSI. Intermediate term, couple of new additions here. The CMB composite is now looking extreme positive. We're back up into the +3 channel again with standard deviation, which is positive, but that's usually when we start to at least watch that a little more closely. The rate of change, which seems now to be a staple on this particular list, because we're measuring way back to much lower prices. And then the momentum oscillators, they are extreme, but they're drifting lower. They're just kind of going sideways to down right now. And the Sean trend meter is also in that initial green area looking extreme positive. We continue to be far away from the 50-period moving average, and then the RSI 14, more intermediate term, that is looking extreme as well. And then a new addition here is the long-term moving average, the 150-period simple moving average. It's getting a little extreme there. The 200, it's not there yet. It's going up, it's positive, but it's not extreme. No change to the overall scenario as it applies to the Fed. They're still in wait-and-see mode. The dollar continues to go down, which is supporting stocks, and interest rates are up. And maybe that curtailed some of the gains here. We're at 4.39%, where we had been at 4.34%. We're still below that 4.5% level, and that's good. But if we start creeping back up to that level, that could put some pressure on stocks. Sentiment, we're back to extreme again. We're at 76. We get nervous when we get close to 75. So we're even above that, where we are actually dropping down a few notches from 73. We're positive with our trend, and we're still going up there. The green line's above the red line. We're above the moving average, and it's above 20. So that is also a trending environment. And now the bias with the up day, that is positive. I've been keeping it as mixed on this part. Now, the bias and the momentum, this is subjective to me. This is kind of a conclusion that I reach. I try to in the videos that I do, let the charts really tell us what's going on. But I just kind of look at the day and say, okay, it was positive or negative or it was mixed. And the momentum is positive as well. That's the last 2, 3, 4, 5 days taken together. Okay, so we did get some economic reports. It's a pretty light week on that front this week. Existing home sales down 2.7% month over month. The seasonal rate is 3.93 million. They thought it was going to rise to 4 million. It didn't. Last time it was up over 4 million. And on a year over year basis, it's unchanged. So we're seeing some slowdown here. Housing prices keep going up, but people can't afford them. You've got rising interest rates, you've got housing prices that are really sky high right now, and so it's harder to sell them. And then every week we get the MBA mortgage applications index. It was up 0.8%. Last week it was down 10%. The purchase index was up 3.5%, where we were down 2.6% with the refinance index. Okay, so here's a chart of the MBA mortgage applications. We saw a pretty significant decline last week. It did come back and was slightly positive in the latest reading here. Also, existing home sales month over month. This shows the decline that we're seeing. Then we drop over to some Isabel Net blog charts here. The 4-week average of share buybacks. This is put out by Real Investment Advice and then posted at Isabel Net blog charts. And this is positive. We're blue, we're going up, and that's seen as a positive thing when companies are willing to come in and buy their own stock back. Okay, then the truck tonnage index, we get this about once a month. Going back to the COVID days, this is where we started to see a disconnect, where the gold line is pretty much going sideways as the purple line, which is the S&P, continues to go up, where you can see for decades they pretty much went hand in hand with each other. But this is probably just changes in how things have switched ever since the COVID lockdowns. And then we get this periodically too, just showing that US stocks are expensive, coming in at 23 here. And then you have the world at 18.9. That's under that 20 level. We still use the 10, 15, 20 scale. And then moving over to the right-hand side of their basic PE ratios from a country perspective. And then exposure to equities really improving here, going up. These are commodity trading advisors, and they're still pretty heavy into stocks right now. And then gold, all right, and you've got people that just love gold no matter what happens here. This is trying to look at seasonality with gold itself and how it's been improving and still looking fairly positive. Okay, and then equity positioning across sectors. This is kind of interesting though. You look, there's actually money going into utilities, which again, I say it's typically been a defensive area, but you could also call it a growth area because of all the shift over and needing so much more as far as electricity. And they're starting to revamp nuclear power plants and things like that. And then there's some money going into real estate. Could be folks trying to, pick some kind of a bottom here, but it doesn't seem to ever really stop. Seeing a lot of money coming out of healthcare and out of materials, which have done well, out of financials, which they've been underperforming the S&P, and then actually some money coming out of the mega cap growth stocks as well as tech. Okay, then 2-year rolling change in the Fed funds rate. With then the grayed areas, this is when we had a recession. With the exception of the mid-1980s, the other examples of 200 basis points of cuts in 2 years happened because of recessions. Okay, yeah, the 1980s, we were just coming out of the 1970s, of course, and there were some really weird things going on here. But this is still anticipating that the Fed funds are going to go down. Is it going to be because we go into a recession? We don't really see that yet. The market doesn't really have that attitude yet, but we'll just be watching things as they develop. Okay, we think the renewed outperformance of U.S. assets has helped spur the dollar's recent recovery. Well, it's not really recovering now. It's been going back down a little bit. My personal take on this, even though I don't do a lot of technical analysis on the dollar, is that it had become quite oversold. And we might have been seeing a bounce because of that. And usually the dollar going down, that does give support to stocks, but now the dollar's been going back down. So this chart's a little bit out of date. Wage growth here, the Indeed wage growth tracker, a measure of wage growth in job postings. It slid 2.86% in June. A fresh low. All right. Labor markets remain on a cooling track. This series tends to lead more widely followed measures of wage growth like the employment cost index. Excuse me, employment cost index, which is a report that we get every month, and I tend to look at that one pretty closely, but this is actually declining. So even though we're seeing lots of job numbers, what about the quality? How about money that's being paid to these folks? This, according to this chart, is actually going down. All right, then Japan versus treasuries. Japanese outflows dwarf foreigner inflows. Japan owns the most U.S. treasuries outside of the U.S. and said Japan won't need to purchase as many treasuries and other foreign bonds and stocks over the long term after the trade deal with the U.S. It's likely going to result in Japan having a smaller trade surplus with the U.S. That would mean Japan has less capital to recycle abroad. And this could put a little pressure on bonds. This might have been one of the reasons why interest rates were up, because Japan is a huge customer of U.S. government bonds. They're not going to be buying as much. When you buy it, that pushes prices up and interest rates down. Okay, equity euphoria indicator. Last week, Barclays. And everybody seems to have their own sentiment gauge here. It's an equity euphoria indicator, which uses options data to quantify giddiness, jump to its highest level. Okay, than what we've seen in quite a while here. And this also goes with some other data that I went through in yesterday's video where we're seeing a lot of call options. We're still seeing a real high reading with the skew index, and kind of piecing this all together, it looks like folks are still anticipating more of a move to the upside. Retail versus non-profitable tech. The 10-day average of retail and non-profitable tech companies has reached 23%. Highest level since they started tracking this. Okay. And then earnings versus margins. While the year-over-year growth rate in trailing earnings seems to have peaked at 10%, margins continue to move higher. We're getting more and more expensive here. Now at 13.1%, it's impressive performance several months into the new tariff regime. There's still debate going on. Is this the tariffs, are they going to cause inflation? Are they not going to cause inflation? You can make a case for either side. We just, again, have to watch as this unfolds. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here is the intraday chart where we had a higher open, and right after we saw some selling coming in, but it wasn't all that drastic. I was wondering if we were going to come down and fill the gap, but we didn't. That's quite often when we gap up and then we'll come down, fill the gap, and then either turn and go up, or if things turn really negative, we keep going down. But we set a pretty good base up here at R1, and then we were able to hold on to that. And then later on, we saw a break above R2, and then now what was once resistance now becomes support. We held above R2 and then started to go up. We got above the 63.50 level. R3 was up here. It wouldn't even show up on the chart if I put it on here. And we closed at the intraday high. All right, and we're up a bit here in the initial overnight session. There's still some optimism coming out. I think it was Google is up after hours and Tesla is down after they reported their earnings. All right, and then this is part of what we've been seeing here, where the red line and the blue line are pretty close to each other. We're seeing the red line actually a little bit above on the intraday chart. This tries to look at how intraday movement goes between growth and value. And not really much of a change here with the growth to value ratio. We saw a big move down in Tuesday's session. Growth really underperformed, and it's just kind of sitting there right now. So our end of day charts, growth was up more than value, at least for the large caps, and it was up more for the mid caps, but up less for the small caps. So we're coming down here, but we're still positive in the bigger picture when we look at small cap growth to value. Mid cap growth to value did improve. That's holding up a little better, but we're not really breaking out and setting a new high with S&P growth to value. When we're setting all-time highs with the index, and this is setting an all-time high at the same time, that's more of a confirmation. Again, not a big deal, but just something we want to watch as we look at these incremental changes day by day. And we actually came down with this growth to value ratio. And still looking pretty good here with discretionary to staples above both moving averages. Recent golden cross here. That is in an uptrend. And both staples and discretionary were up. But we want discretionary to outperform. That's more positive. And here we are with the short-term trend. We saw the green line coming back up. We're still above the moving average. We're flattening out a little bit with the ADX, but it's still positive, showing we're in a trending environment. A little bit further above the moving average here in the intermediate term, with the green line going up and the red line going down. So this short and intermediate term is positive here. We are above average just a little bit, really hard to see, but a little pickup in the volume in Wednesday's session. Sentiment, we are coming down still with the VIX. We're below 20. That's more positive, both with the line chart and the bar chart. We continue to be below the moving averages, and the moving averages are declining with the VIX of the VIX. That's more positive. But we're up in the red area and continuing to go up, so there's some speculation out there. Now we're concluding that these would be call options, which increase in value as the market goes up, thinking that there's going to be a real move to the upside. But a lot of times options traders are wrong. And if they had a lot of confidence in this, they would be buying the actual stocks rather than the options, because options don't cost as much there. And we did decline with this fear gauge. We're also declining with the other fear gauge. So fear is coming out of the market, and we see confirmation there. And ticked pretty much sideways here with the equity put call ratio daily chart. And we're turning back up a little bit right at this red line here with the 5-day chart, but we're continuing to decline with the 10-day chart. And we keep going up here. We're not at all-time highs yet with the risk on to risk off ratio, but it did improve in Wednesday's session. And overall, this has been going up. That's more positive for the market. And starting to get a high reading here. Pretty high here with the volatility risk premium. And there's some fear that's anticipated out there that we're not necessarily seeing in other indicators. Advanced decline line setting a new high based on price and volume. That's a positive thing for the S&P. Above zero when going up with the advanced decline oscillator. Above zero when going up with the short and intermediate term advanced decline ratio. We saw a nice little breakout here of the new highs, so we're turning back up with the 5-day and the 10-day moving average. That's positive internally. And all three of our smart money indicators have now switched back to positive. We're above the rising red line here with the accumulation distribution. And the boom indicator is starting to turn back up after it had been drifting sideways to down. We're positive with the Chaikin money flow. The red line's going up, and we're back to positive. We went up and crossed above the moving average with the Chaikin oscillator. Positive with the vortex. Getting a little concerned here as we saw the green line coming down and the red line going up, but we saw a bit of a bounce up in Wednesday's session here. Setting a new all-time high with the cumulative advanced decline line based on price and volume. That's a positive thing. Seeing more power behind volume, which tends to be positive if it leads price. Advanced decline lines looking good, all above advancing moving averages here. And setting a new all-time high with the NYSE common stock based on price as well as volume. So that's more broad market participation there. Improving with those stocks in the S&P above their 20-period moving average, 50-period moving average, 100-period moving average, and 200-period moving average. So we're seeing more broad participation that way. This is another show or another look at how we're showing that the broad market is participating. The 5-day moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE above zero and continuing to go up. Short term, breaking out above this dashed line. I've been pointing this out. This was acting as some kind of overhead resistance. We finally were able to get above that. And now we already have the pivot points for August that are on the chart. And for 2 days now, we've been slightly above average with volume. Still looking positive here with the 20, 50, and 200 period moving averages on the S&P. After being extreme negative, we're already back to extreme positive with the Stochk RSI. That's showing good shorter-term momentum. The Williams percent R, which has been on this list now for a few days, that's showing good short-term momentum. The CCI 14 and the CCI 20. So we're seeing some confirmation there. Stochastics, really extreme here with the short-term stochastic, turning back up and extreme with the intermediate short-term, and finally starting to turn back up with the long short-term stochastic. But all three of these are above these lines that mark extreme positive readings. Finally getting back above the midpoint with the force index. So that's an improvement there. The short-term trend still looking good. The green line, the blue line continue to go up. We're up into the high end of the +3 channel with the standard deviations chart. Again, that's not necessarily negative, but usually there was one day we got up into the +4 area. We don't really see that, but this also can suggest good positive momentum, but it also looks a little toppy at the same time. Now, this is interesting. The balance of power continues to decline on an up day, but it's still positive since it's above zero, though. And looking good with a 10-period moving average steady. The green line's back to going up. The green line's above the orange line, and the orange line's above the blue line. All of this is still positive here. Starting to get extreme with the CMB composite. We're getting above that black line. Still positive with the go, no go, darker blue bars. Coming up, actually exceeding the highest high value here with the midline that continues to advance. That's positive. And as I've been pointing out here, this is positive with the Landry light. It's just when we get above this dashed line, that means that we've been here for kind of a long time. And that's all we want to take from that. Not that it's predicting that it's overbought or oversold. We use other charts for that. But this just means that we've been this way for quite a while, which also shows that it's a positive market. We are positive with the proper order. That continues to advance. We're still declining, though, with the TTM squeeze. Darker blue and declining. Still extreme with the rate of change going back 50 periods. Still hovering along just slightly above zero here with the ease of movement. Positive with the Arun, above zero with the oscillator, showing there's more buyers than sellers. And above zero with the S&P McClellan oscillator. That did improve in Wednesday's session, so we're now back to seeing more of a confirmation here. We were getting a mixed picture where we were slightly going up based on price, but we were still declining based on volume. Now they're both starting to turn back up. And we're back above zero here with the NYSE McClellan oscillator, where we had still been below zero. So it's hard to see, but we're turning back up with the summation index based on price and a little bit more strength here based on volume. Swindling trading oscillator advancing based on price and volume. That's positive. And improving when we look at price and volume for the PMO, but it hasn't come back itself and actually crossed above the moving average. But it's extreme since we're above this red dash line, or not dash line, just this red line here. Excuse me, but we are improving and above 50 with the PMOs that are rising. The buy signals are improving, but still just slightly below 50 and turning back up and still giving us quite a high reading here with the PMOs that are above zero. And we've gone from neutral to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're still declining. It's trying to turn up here with the slope oscillator, but it's still extreme positive since it's above this green line. So it's extreme positive, but negative since it's below its moving average. And we're continuing to decline, but possibly trying to turn up here with the MACD. So our momentum oscillator is still not showing a lot of strength. Now the TSI, that's why I use more than one. It's looking more positive. It's already extreme here, but it's trying to get back above its moving average, where the slope is continuing below its moving average. And then we have our three intermediate term oscillators here, the MACD, PMO, and PPO. They're continuing to drift down, going down slightly here with the tricks, and pretty much flatlining right now with the KST. Those are the two long-term oscillators. Still negative with the Copic curve. Extreme here. That's showing good positive momentum in the intermediate term with the Sean trend meter. Above 50 with the money flow and ultimate oscillator. Above the moving average with on-balance volume. And the moving average is going up. That's positive. Starting to get extreme in the intermediate term. RSI based on 14 periods. Already extreme with the RSI 9. That's short term. It's still looking good with our intermediate term trend. The red line and the blue line continue to go up. We're above all the plotted moving averages, and all the moving averages are going up. That's positive there. We're getting far away again from the 20-period moving average. We've already been far away from the 50-period moving average, as measured by the boom indicator. And we're back above the moving average here with bullish percent index. But we're getting a reading right at 70, so that's starting to get extreme again. And going back up, seeing a little bit of improvement here with the NYC bullish percent index, but you notice how this went down? The NASDAQ 100 bullish percent index is actually showing a decline. Now it's still positive since it's above 50 and still giving us a high reading, but the context is that this has been declining. This is part of what I'm talking about. Where are the big stocks really going to be able to drive the market? Now that could change. We're just not seeing that right now. And we're up almost 1% now for the week. This is still looking good with the weekly bars showing higher highs and higher lows. And we're positive on the trending front here with the Heiken Ashi looking positive. The Kigi chart is black and pointing up. That's positive. The Renko chart with open blocks, that's positive. And we're back to looking a little stronger here with the 3-line break, which is positive. Had enough of an upward move to draw in a new X. We're still working off of the ascending triple top breakout that was generated back on June 6th. So this point and figure chart is still looking positive here. Long term, we're getting above this red line with the 150 simple moving average. We are improving, but not extreme with the 200 period simple moving average. Positive on all time frames across all the different indexes that we look at for stocks. Bonds still looking positive in the short term. Commodities are positive on all time frames. The dollar is negative on all time frames. And we had utilities. They were the only sector that ended up being down. Now, healthcare, it's bouncing back up. It was the strongest performing sector. Not what you would usually see on an all-time high day, at least for the S&P. And then staples really were up just a little bit. That helped. Where discretionary did outperform. Communication was up, but not all that strong. The same thing about technology. So we're not seeing a lot of the growth areas at the top of the list. So we had utilities have a BPI. First, they crossed above 70, then above 80. That's interesting. Canada, another new all-time high. S&P all-time high. Then we had a BPI cross with the tech sector crossing below 70. Little bit of a concern there. We're looking pretty good, but we're seeing some negative signals from the charts. Industrials had a BPI cross below 80 and financials below 70. See, these are the areas that kind of help the market really do well. We're seeing some internal weakness here. Again, this could all change and shift back and look more positive, but this is just the warning signs that we're seeing right now. As the NASDAQ continues to go up, it got above 20,009, then above 21,000. The Dow got above 45,000. So, I mean, it was hardly anything negative. There's just some, it's not the strength that we usually see when we're setting all-time highs. So not much change. Nvidia had a pretty good day here, but Microsoft, and it was barely up, and Apple was barely down. And then the financials, a lot of green here with the bigger companies. And then Amazon was up a little bit. Tesla was up just a little bit. Google was down where Meta was up. And we did see an improvement here where the red line is starting to come up and actually go slightly above the equal weight version of the S&P. That just means there's more stocks in the S&P that were participating in Wednesday's advance. The Dow did finally get above this R1 pivot point. We're not back to an all-time high yet, but we are in an uptrend with the Dow, and we are looking positive here with the diamonds when looking at the Elder's Impulse system. And we did set a closing high here with the NASDAQ. We're still above this R1 pivot point after recently generating a golden cross, but we're still neutral with the Elder's Impulse system. Not enough of an upward move to change that over to green. The NASDAQ 100 kind of underperformed. It's still under this R1 pivot point here. We'll be watching this to see if this produces some kind of overhead resistance. Still neutral with the Elder's Impulse system for the Qs. Momentum just kind of blah, blah, drifting down here. Not really seeing an awful lot of strength. You could show this as a negative divergence as we've been going up here based on price. We've actually been going down with the momentum oscillator. And coming a little bit above this long-term trend line here. And about the time we hit this is when things started to slow down for the NASDAQ 100. And we're up, but we're not above these previous highs here with the S&P 600 small cap index, but still had an up day, up over 1%. And looking a little better here with the Russell 2000 small caps, getting close to a golden cross, but we're not there yet. Positive with the Elder's Impulse system for the small caps. Mid caps also still under this R2 pivot point, but they were up 0.82%. Positive with the Elder's Impulse system with the mid caps. Wilshire setting a new all-time high. Seeing broad market participation there. That is positive. Also setting a new all-time high with the total U.S. stock ETF. Financial sector was up, still holding together when you look at it by itself, but it's still below the 200-day moving average when we do a ratio of the financial sector to the S&P. And kind of going sideways right now with the FANG index. These are the really big stocks. And I mean, they're doing good. They're not just really breaking out and setting new highs, though. So Apple was down 0.12%. We had Amazon in an uptrend, up a little over 1/3%. Google just starting to generate a golden cross here, even though it was down slightly. Microsoft virtually unchanged, but in an uptrend. Meta was up over 1%, still above its 50-day moving average. Nvidia, recent golden cross, up 2.25%, but not back to an all-time high. Tesla, really quiet here, up 0.14%, and it's down after hours. Kind of price and the moving averages are kind of mixed up with each other right now. Netflix, this is interesting. This has been one of the better performing stocks, not only in 2024, but in 2025. It held on to a more solid uptrend, but it's now down over another percent lower, falling further below its 50-day moving average. And then we look at the relationship between U.S. and world stocks, seeing a little bit of improvement, a little bit of strengthening in the correlation in the short term, still drifting lower with the longer term correlation. Oil, virtually unchanged, still in the mid 60s, and the dollar continues to be in a downtrend. And Truflation coming in at 2.01% with their reading on inflation, as opposed to the 2.7% we received last week when CPI came out. And we are going back up here with the 10-year yield, and we're watching that 4.5% level. We're still a ways away from it, but we just want to keep an eye on this. And we're still above the 50-day moving average with the 10-year based on price. Momentum, it was trying to turn over positive, but not quite there yet. Still above 50, but declining with the RSI with the 10-year based on price. Not really much of an improvement here, falling a little bit below the moving average with the Qs to S&P ratio. A bit of an improvement, still above the moving average here with discretionary to the S&P, even though it ticked down a little bit. We're coming back down to the moving average when we compare large cap growth to large cap value. And so we're a little bit above the moving average with the large caps, coming back up to the moving average with the mid caps, and falling down below, further below the moving average with the small cap growth to value ratio. So we're still dealing with earnings season, and that probably will be a stock by stock basis unless one of these big companies come out that really have most of an impact on the market. But we're still positive on all time frames, and we're still trending there. We're going to get initial jobless claims, probably one of the biggest reports of the week, as well as continuing claims. New home sales will also be coming out. Now, some folks think this is important. Now, it's the U.S. manufacturing and services PMIs that we really watch closely. This is global. And again, if it's above 50, that shows expansion. Below 50 shows contraction. So we'll be keeping an eye on that as well. And then any new trade deals that come out, any tariff announcements. Of course, there's all these geopolitical things that could erupt and become at the forefront of the news at any given time. Here is a look at Friday. We'll have durable goods coming out. This is what will be coming out on Thursday. And then again, durable goods on Friday. Seasonality, we're actually negative for the Dow on July 24th, where we're neutral to positive with the S&P and neutral to negative with the NASDAQ. So kind of not really a lot of conformity there. We are still in the week after options expiration, which going back to 1980, it tends to be down more than up. And here's a look. But when we just look at post-election years, this still holds up fairly well. The green dashed line, that's the S&P. This holds up fairly well compared to other types of seasonality that we've been keeping an eye on. This just, again, shows how the second half of July underperforms the first half of July. This also is shown by the Carson chart, seeing a lot of strength in early July, and then it tends to taper off as we work our way towards the latter part of July. But even they have a nice little bump up going here. This goes back to 1950. With each video and course, members learn to implement the consensus approach. a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, so the warning signs, the momentum oscillators are not really kicking into gear. They're still sideways to drifting lower, as well as the Copic curve. And the momentum for the NASDAQ 100 continues to drop off. And the long-term special K chart, which I usually only show in the weekends, that's still negative. And then we have a long-term sell signal with the Zohorchak method. A lot of positive things, though. All three of our smart money indicators are now back to looking positive. The growth to value and discretionary to staples ratios, those continue to be positive. The S&P and NYSE McClellan oscillators and summation indexes, the McClellan oscillators are above zero. When they're above zero, that makes the summation indexes start to go up as well. Parabolic SCR is positive, and we're looking positive with the bullish percent indexes. I should have taken this out. They're not declining. They actually showed a bit of an advancement. Swollen trading oscillator is positive based on price and volume. Ease of movement, money flow, and ultimate oscillator. They're in white here because I consider them to be secondary indicators. The yellow is kind of like right in between primary and secondary, where the gold, that's what I consider to be a primary indicator. The vortex continues to be positive, and the financial sector is also positive. Here are the pivot points for Thursday's session. All right, our conclusion, no changes on all time frames. We're positive, we're trending, looking, setting all-time highs. So looking pretty good from that particular perspective. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.